All right, welcome back, traders. John Caruso here, Monday, November 14th. Quick pre-market video for you guys, but first we're going to take a quick look back at some of the developments that took place late last week. Thursday last week, we did see the headline CPI number actually cool on a year-over-year basis, 7.7%. That's down from an expected 8% and the previous reading of 8.2%. The market looked at that as risk on. We did see a 5.5% move on the charts on Thursday alone in the S&P 500. We had the midterm elections in the rearview mirror, and we had the CPI coming in cooler than expected. It was pure risk on in the back half of last week. We saw 5.5% on Thursday. We saw another follow through on Friday of up 1% in the S&P 500. To take it up north of 4,000 on the charts here. So when I look at the setup this morning in stocks, we've got some heavy implied volatility discounts, which is telling me that the market, that Wall Street is chasing this market. They've covered a lot of their downside hedges, and they're getting net longer of stocks right here at this point. So while I do recognize seasonal strength in the market at this time of the year, I am actually expecting a check down, a check down on the charts for perhaps a couple of days to maybe where we retest that midpoint on Thursday's rally in the S&P 500, which would come in down at 38.75 before maybe this market has something bigger to say on the upside as we move into the holiday season. So that's kind of my immediate term outlook on the S&P 500. I don't want you to be confused. I am still an ardent bear of this market, but I do recognize what I'm seeing on the charts right now. We've got a bullish, choppy upside bullish trade happening right now in the S&P 500 within a longer term bearish trend on the chart. So how long could that last? Well, perhaps we could run for the next 3 or 4 weeks going into that December Fed meeting, and then I would expect to see the market start to consolidate, chop, and perhaps peak and roll back on the downside sometime out in early 23. So that's what we're going to looking at in the S&P 500. Bond yields had a big move down last week, down 34 basis points. We broke that key support level at 393 on the charts. It would take a move down to 355 and multiple day closes below 355 to flip the yields chart to bearish and us get bullish on bond prices. So I'm not quite there yet, but I am recognizing what's going on in the charts. I do think the highest probability is that we do see yields likely stabilize down here right off of the 50-day moving average and try to chop a little bit higher before perhaps we see the bond market start to price in more peak hawkishness by the Federal Reserve. You got to remember that that's what's a driving force here. With the cooler CPI number, the market is trying to front run peak hawkishness by the Fed. Are we there yet? I'm not quite sure. I still have my doubts. We do know that the Fed is expected to raise 50 bips at the December meeting, which is of course incrementally less than what was prior expected of 75 basis points. So we're going to continue to watch the data from here. These markets are largely being driven by the direction of the data. Oil prices, we did see over the last 2 weeks, oil prices actually rotate back up to the top of the range. You've got a range in oil about 93.50 on the top side, 81.50 on the downside. We were hovering around 85, made that run to 93.50, rejected it hard, rotated back to the downside, and here we are. We're sitting at about $88 a barrel here this morning. I'm going to give the bulls the benefit of the doubt right now in the crude oil market that we can re-attack 92, flip back to bullish trend, attack 93.50, and potentially push up to 98. If that does not come to fruition and we in fact rotate back down in crude oil, back down through 85.30, that's going to be a key level. Rotate back below 85.30, then I think it's a high probability we're going to retest 81.50. So a lot of indecision right now in the oil market as we're just kind of sitting right in the middle of that range. So gold had a lot to say over the last 2 weeks. We mentioned several times that we had that triple bottom on the chart. Any price acceptance above 1680 was going to be important for gold. And here we are ripping higher in the gold market. We're sitting at about 1766 here this morning. So that's all I have for you here today. Best of luck to everybody out there. We're going to catch you back here next time. Take care.